In this week's episode, we're going to talk to a wealth manager of some of the very wealthy people in the United States. We're going to ask him good questions I think all of you would want to know as you're looking forward to taking advantage of the windfall that you expect to have in your investments. And we're going to explore how people with large wealth address managing that money. And this is a prospect all of us hope that we have. So please stay tuned. It'll be a very interesting show. In today's episode, I have with us Stefan Whitwell, who is a financial wealth advisor. Say hello to us, Stefan.
Great to see you. Happy to be here, Clinton.
Well, I tell everyone, Stefan came to me because he had a client with a large cryptocurrency portfolio, and I'll just characterize it as being significantly greater than $10 million, just to give perspective. And what I found was very interesting was that when you come into that type of wealth, it creates a complex set of decisions that involve how do I do tax planning? How do I do wealth planning, inheritance planning? How do I diversify my funds out of that one, in his case, in cryptocurrency that he invested in, to diversify it in a way that helps create more economic safety and long-term wealth and inheritance. And so I thought it'd be really good to have that discussion with you today, Stefan, and you can talk to our clients who can start thinking about what their prospects are like in that area. So Stefan, why don't you take a little bit of time and tell us about yourself and your business and how you help people?
So it depends on who you ask, right? If you ask my kids, their nickname for me is Action Daddy. I love being dad. And I also love what I do. I run a nationwide wealth management firm, but I haven't always. I started out on Wall Street before moving to Main Street, as it were. And I love the complexity. I loved learning about the sophistication. It was fun at a young age to be working with a lot of commas and zeros. But what was missing for me was that connection with the end client. Because what happens in Wall Street is there's often a number of institutional intermediaries, middlemen between you and that end person whose life depends on making smart choices. And I'm not big on bureaucracy. It just kind of got old pretty quickly with all those, people in between. And one day a mentor of mine asked me a question that changed my life forever when he said, "Hey, have you ever thought about doing private wealth management, given your background?" And no, I hadn't, but I'm glad he asked me that question. One thing led to another, and we've been building our own firm because, as I'm sure a lot of you watching the show can empathize with me on, is that so much of the wealth management industry is just stuck in kind of this 1950s paradigm of there's only stocks and bonds and traditional type of investment accounts, and that's it. And I think the explosion of interest that we've seen in the crypto space and other areas like venture capital, private equity, collateralized lending really speaks to the fact that people are saying, hey, there can be some good opportunities in the public markets, but I don't want to do just that normal kind of stock, bond, mutual funds, ETFs. What else is there? And so I think one of the things that holds people back, Clinton, from diversifying is their fear, which I totally get, that, hey, if I go knock on the door of a wealth management firm, they're going to want to just stick me in really boring stuff that doesn't excite me, that I don't necessarily have confidence in. I don't see myself wanting to be completely invested in mutual funds, even if it is diversified. And I think that's just important to acknowledge, because that sometimes stops people from taking the important step of putting a plan together. The other thing that stops people is fear of missing out, right? We even have a word for it, FOMO. And this is not limited to crypto. I've seen this in real estate. I've seen this in equities, where you have somebody who has done extraordinarily well in one asset class. And they've done well to HODL it, so to speak. They've stuck with it over the years. But there comes a point where you'd be really smart to secure and protect some of that capital. And that can be a really hard emotional decision, because for so long, the right decision was to hold on. And so I think that the other thing we just need to acknowledge as part of that process is the importance of acknowledging that and talking it through. And then really just helping people see from historical example in lots of different other types of asset classes how even the best asset classes can have significant corrections, right? I mean, crypto is volatile, yes. But guess what? So are technology equities, right? We've seen the so-called FANGs trade down significantly. I looked at Facebook the other day. I think it was down 75% from its high, recently. And of course, this year it's gone up a ton. But there reaches a point in life where you go, I'm not comfortable, given the wealth that I have today, of a 75% drawdown. So what can I do to position myself so that I'm more protected? I still want some skin in the game. I still want to participate. But what can I do that will protect a chunk of my wealth? And part of that also needs to incorporate cash flow. Part of that you need to think about liquidity. Part of that you need to think about tax planning, which is near and dear to my heart. But I think it's just important, Clinton, when we think about why people don't do it, is to really acknowledge that, and I think this is really true in the crypto space, that people are like, hey, the market doesn't do it for me. I want to have other assets. What other assets are there that I can invest in? And here's an interesting fact. If you look at the largest brokerage firms out there, Merrill, Goldman, Morgan Stanley, or the Fidelity, Schwab's of the world, they only offer you traditional accounts, right? I mean, that's why companies like Coinbase have grown so big, and other crypto brokerage firms. They only offer you, I mean, yes, some of them have recently come out with some kind of a crypto offering, but fundamentally, the accounts that they offer you are traditional. And one of the things that we are very passionate about is the private investing, alternative investing world. And so it's always surprising to me when we meet people and we talk about self-directed IRAs or self-directed Roth accounts. And they're like, I didn't even know. I've been an advisor for 10 years. I didn't even know that kind of account exists. And you kind of got to ask yourself, well, why? And the answer is pretty obvious that, well, those big firms produce their own ETFs, their own securities. They make money by getting you to invest in them. So that's why they focus on those kind of accounts and don't, even tell most people that, hey, there are other types of accounts you can open that would open the door to you to a significantly wider array of investment choices. The other thing I hear from clients all the time is this sense of, nobody wants to be sold, right? And our industry often has the reputation, whether it's insurance or annuities or your typical stockbroker, hey, the answer is buy ETFs. What's the question? Or, oh, the answer is buy insurance. What's the question?
Exactly. It's the old, to every carpenter, everything looks like a nail. And you feel that when you go in and talk to somebody, they're like, push you into some stocks. Like, I really don't want stocks. I could do this myself, if that's what you're telling me. If it's just stocks and bonds, because everybody offers stocks and bonds, but the creativity, the ability to help you think out of the box, that's what you're looking for. And you don't get it.
No. The other thing you don't get is a plan. And by a plan, I don't mean some 70-page template document that's full of a bunch of lingo that nobody's going to want to ever read. But by a plan, I mean, where are we today? Where do we want to get to? And what are the action steps that need to be taken, and by whom? What are the action steps that I, the client, need to take? What are the action steps that you, the advisor, need to take for me and my family to get us there? And, I see that in tax planning all the time. I see people, hey, you have a CPA, right? Yep. Or maybe people do it themselves, and I'll say, hey, you've got $15 million in net worth, or 10 million, or 5 million, or 2 million. Do you have a tax plan? And they look at me like, what do you mean a tax plan? Like, just that, like a 2-pager that says, here's where we're at, here's where we want to get to, and here are the steps to help you get there. And what I mean by that, and this is really important to say, what I'm not referring to are all these fly-by-night, too good to be true schemes that you hear people trying to sell you, whether it's like hyper-leveraged airplane leases or movie deals, or, recently we've seen a lot of weird stuff in conservation easements where, hey, invest $1 and you get a $5 write-off. I'm sorry, but that too good to be true stuff is likely going to end up in a nasty audit. What I'm talking about are the basic legal permitted building blocks that for some weird reason people aren't taking advantage of. Everybody has, to put it in really easy to understand terms, we all have 3 different tax buckets. We've got our taxable bucket, which is like your standard, hey, I put $500,000 into a Coinbase account in my name. That's a taxable bucket. Then you have your tax deferred bucket, where that's like a 401k or an IRA, right? And then the holy grail is the third bucket, your tax-free bucket. And traditionally, 2 vehicles that people use in that bucket, one is permanent life insurance, but the other is Roth accounts. And Roth accounts are one of the most underutilized, most powerful types of accounts out there, particularly when you get a self-directed Roth account, which gives you access to a much wider range of investments, right? In a traditional Roth account, you can't trade crypto. In an alternative Roth account, you can open up a crypto account. You can invest in venture capital. You can invest in real estate. There's a lot of different things you can do. And of course, when you make those investments inside of a Roth account, a couple good things happen. Number one, all the gains on that are tax-free. Number two, maybe many years down the line, your heirs, if you don't need all that while you're living, and you have heirs that you give that to, the heirs receive that tax-free. And you also aren't forced to take money out of it in the way that you are in IRA accounts. There's things called RMDs that when you reach a certain age, the IRS forces you to take money out of that account. And when that happens, you've got to pay extra taxes. You don't have to do that in a Roth account. And so one of the very kind of high level goals of tax planning is, and you can do this right now as you're watching this up, and draw 3 big circles on it, side by side, and label them taxable, tax deferred, and tax free. And now I want you to put the percentage of your net worth that is in each of those 3 buckets. Just write a percentage in each bucket. You can do it after you finish watching, and just look at that. And for a lot of people, when they do that exercise, they go, wow, most of my wealth is not in the bucket that I want most of my wealth to be in. And so tax planning is about methodically, over time, figuring out the best way to put as much of your money as possible into your tax-free bucket. So for example, I have a client that loves to trade, and he's very good at it. Well, when we first met, we're talking about this, he had all of his trading in a taxable account. So every dollar he made, he had to pay tax on it. I said, why aren't you doing this in a Roth account? And he's like, I didn't even know you could do that. I thought Roth accounts were like this really boring, old, stodgy thing, just mutual funds. Like, I didn't know I could. Yeah, you got to get a self-directed Roth, open it, and you could do all sorts of things. I think, there's kind of this perception out there that, wow, I didn't realize I could do some of those things. But tax planning at a very, very high level is about trying to move more of your assets into your tax-free bucket. And that could take 2 years. That could take 10 years. There's no magic baton. There's no magic product. It's just rolling our sleeves up, looking at your income and figuring out the best timing so that when we move that money into the tax-free bucket, we're doing so at the least cost possible. And again, that takes some time. It's not, it's not a, hey, buy this product and it's all done, right? It's just good old fashioned planning, thinking ahead. But the result of that can be shockingly good. In fact, I have a confession to make, Clinton. I am a bit of a spreadsheet nerd. My first 2 years working on Wall Street, that's all I did, the spreadsheets. I was an investment banking analyst in M&A for James D. Wolfenson. It was very, very exciting, but I never left the office. All I did is spreadsheets. So they're kind of secondhand. And so I had to be really open. I had a financial setback in my life around 2009, 10. And so I'm like, hey, I need to rebuild I need to use every available tool I can to rebuild. And I realized at that point that I had not been fully leveraging the benefit of tax planning. So I started to nerd out and look at some of these basic strategies, like the one I just shared with you, and kind of modeling that out, to understand, is this worth the effort or not? I was shocked. When I first ran those numbers, Clinton, I thought I for sure had to have made a mistake in the spreadsheet. So I trashed the spreadsheet, I rebuilt it. It was so shocking to me that so few people in our industry do that and take full advantage of that. I'm like, why not? And maybe we were talking earlier before the show today, Clinton, and you made the comment that a lot of people in our industry are focused on just one thing. I focus just on mutual funds. I focus just on insurance. I focus just on annuities. But to do tax planning, you have to be integrated across everything. It has to be really holistic. And when I did the spreadsheet, I was shocked. I'm like, well, that's what I need to do. And so that's what I'm doing for me. It's not that I'm telling you, hey, you need to do it. I'm telling you what I'm doing, what I would do. And when we sit down and quantify for clients, hey, over the course of your life, this is how much difference it can make, they're shocked. Just shocked.
Well, you're talking my language when we talk taxes. So many people call me up and they say, yeah, I want you to do my taxes, and can you give me some tax planning ideas? I want to make sure I don't lose money on my taxes. They ask it so casually, like, oh yeah, I got 2 of those things in my pocket. I can share them with you right now. It's a logical question. I'm not going to diminish that. They're coming into a lot of wealth. They've heard about, like you said, some great plan over here. Oh, charitable remainder trusts or self-directed IRAs, or there's guys out there that promote these things like they're the salvation of the world. And I just really can't give them that advice, because it's really not a 10-minute conversation. And it's not something that you execute in 2 hours. Like you said, it's a plan, and you execute that plan over time. It's going to take months and years to transition to the point where you want to be. And a lot of these tools that you hear about are great tools at the right time in the right circumstance. And I think what you're saying, by having a plan, what's your cash plan? How are you going to have cash on a regular basis? Okay, now what are big savings events you want to have? House, college, retirement. Now let's start to put some mechanisms in place that address those needs and start to move you from a taxed bucket into tax deferred and tax free. And there really are some great tools out there. They're not free, and as you move into more sophisticated tools, there's ongoing annual costs, but these are, if you're investing at the right time, they're minimal in comparison to the overall gain you're expecting, but not something you're going to do right away coming out of the gate. A lot of times when I hear a pitch, somebody pitches some particular solution as the solution, and I study it, I understand accounting and taxes, but I don't get into the investment side as well. I start to get into this place where, like, it just starts to fuzz over. I'm not going to do this. I'll just leave my money in the bank. I don't know what to do, but bank is a safe place. But I think a lot of people at the same time are starting to realize, is bank really a safe place? And I'm hearing a lot from commentators about how the banking system's unstable. It's hard for me to see that, because we talk about bank runs, but I don't see 1920 style bank runs. I can still go to the ATM machine and get out a couple $100. What does a bank run look like? I know a couple months ago, I know it's been chewed up in the media a lot lately, but it's probably good, as we have time to reflect on it, to reconsider the bank collapse of the Silvergate Bank, which I think was like the 16th largest bank in the US, which most people had never heard of. And then there was some other bank in Connecticut, and there were some other banks that got shut down. I mean, the media kind of poo-poos this. It kind of keeps it simple, but I still hear there's instability in the bank. What's your take on that? I mean, is a bank really a safe place to keep your money?
I think that's a really interesting question from a couple different perspectives. First is, I think banking as a sector is going to change dramatically in the next 5 to 10 years. One of the reasons why is the transparency that the internet brings, right? The average, as of April of this year, the average interest rate paid in a savings account, not a checking account, but a savings account by banks in the United States is 0.4% per the FDIC.
Get these advertisements for CDs saying, lock up your money, we'll give you 0.6%. It's like, you really seriously?
Or get a disappointment, I mean, they lock you up. So as an example, and Today, if you pick the right money market fund that is not taking credit risk, you should be able to earn 4.5, 4.6%. That changes weekly, but about 10 times more than what the average person's getting in their savings accounts. I think that when the difference is, zero point 0.4 versus zero point 0.5, it's such a small difference. People are like, whatever, just convenient, I'll keep it there. But when the difference is 10 times the difference and, 4% difference on a large amount of cash can really add up. It's like, hey, do I want to take that money and go on a vacation to Italy with my family, or do I want to let the banker take my money and do that? Pretty clear which one I'd vote for. And so I think that as more people wake up to that, money is going to be leaving banks. And banks have traditionally made a lot of money benefiting from cheap deposits, which is another way of saying benefiting by being able to get away with paying people very, very, very low rates on their savings accounts. And that's going to change. One of the other catalysts for the change, aside from transparency, Clinton, is that large brands like Apple have come out and gotten into the fintech space. So Apple, a couple of years ago, partnered with Goldman Sachs, and they came out with this cool metal credit card. And they recently added a savings account, and they're paying 4.1, 4.2 or something. There's a lot of people out there that are committed Apple fans, right? And they're going to go, wow, that's funny. Apple, I use their Apple phone, I use my Mac, I have an iPad, and they're now paying 4.2 and my bank's paying 0.4. I mean, that's a no-brainer, right? Apple's a strong company. They're going to trust them probably more than the bank, and they're not. So I think that things like that, there's a lot of other companies that are getting into that space. The third thing is, I think many people would agree, is that banks are not necessarily known to be very entrepreneurial, not very innovative. And so a lot of people I know don't really like banks because they tend to be bureaucratic, slow, and the technology is not really that great. I had an experience recently where my wife and I were talking, and we opened up a new savings account for our newborn. And I knew I had done it, but she's like, yeah, but it's not on my account. And then I looked on my phone and it wasn't there either. I'm like, that's really strange. I could have sworn that I opened an account and funded it with some money. But I mean, I've got 4 kids, running a business, life's crazy. Sometimes I can't remember what I did last week. So I thought, oh, maybe I'll check with the bank. So I checked with the bank, and you know what they said? They said, oh, well, your savings account has not seen any transactions for 9 months. So we made it dormant and we took it off your login. I'm like, you what? It's a savings account. It's not supposed to be active, and so there's just things like that still happen that I think are kind of behind the times in terms of the level of service and kind of common sense and innovation that people expect from brands that they love. The other thing that strikes me in the banking sector is if you look around most cities, there's just a gazillion banks on every corner, right?
Yes.
And they're still building more. I'm like, do you think we need another bank branch? I mean, when's the last time you went into a bank branch? You're like, oh, this is really enjoyable. I had a really great experience. 99% of the stuff I do, you do, we can all do online. We don't need to actually go into a branch, but yet they've got billions and billions and billions of dollars of real estate tied up. And I think is really a misappropriation of assets. It's in the wrong place. So I think the banking sector itself is going to radically change and have to be reinvented. And to be clear, banks play a very vital and important role in our economy as lenders. And I think that they've kind of lost their direction to some extent because they've gotten involved in all these other things. But fundamentally, that's what people want and need from a bank. It used to be that people also wanted to have their money safeguarded in a bank, right? Think, 1850s and, how do I literally physically protect my money? But we live in a different world now. And, cash is almost non-existent. In fact, cash in many European countries is nearly outlawed, the amount of usage of actual cash. And so the act of protecting it has actually gone to be more cyber oriented than physical protection, which is what it used to be. But to your question, Clinton, the banking sector, if there's one thing you need to take away, maybe 2 things you need to take away from the recent spate of bank failures is, number one, look and see what yield you're getting. And if you're not getting a 4.5%-ish yield, then you might ask yourself whether that makes sense, given the amount of cash you have in there, and what can you do to get a higher yield just to make sure your money's working for you.
You hit a great point, because we hear about inflation, which is how much your money's eroding. So I don't know what the inflation rate is. Depends how you measure it. I hear it's like 5-6%. But if the bank is only paying you 4%, that means you're having a 1 or 2% slippage on the value of your purchasing power of your cash, if that's the investment. And rarely do you ever see a bank give money that's greater than the inflation rate.
That's right. That's exactly right. And so, if they're paying you 0.4 and inflation is 5, then that's painful, right? That will erode that money measurably year to year. If you're getting 4.5 and inflation's down around 5, and you want to have some money for kind of a rainy day fund, okay, the slippage is a lot less. It's not ideal, but it's a lot less. So the other thing that, just to briefly share, that is a key takeaway from the whole banking crisis, is understanding the difference between what a bank is and a custodian. And most people it's not been top of mind for them. But it's so important that you walk away from the show with total clarity as to that difference. So a bank takes all of the money in all of the accounts, commingles that, and invests that money, hoping to make enough that they can pay you your 0.4%, that they can pay their operating expenses, and then they can put money in their pockets, right? That's what a bank does. So when you see a statement from your bank and it says $200,000 in your account, that's actually not true, because banks don't keep that money in your account. They take it all, they invest that, and then when you want that money back, that's where they have to maintain a certain amount of liquidity so that when people go, hey, I want my money back, that they can give that money back to you. And what hurt Silicon Valley Bank is that too many people at once said, hey, I want my money back, but their money wasn't actually in their account. And so they got into trouble, right? They had that liquidity crisis and were ultimately shut down. A custodian, by contrast, is not allowed to take your money and bet it. A custodian, literally, when you get a statement saying you have $200,000 in that account, you literally have $200,000 in that account. That money is sitting there. They have no permission to take it out and to commingle it or to do anything with it without your explicit permission. The money is what we call segregated accounts. Every account is separate, and your money, your securities are in that account. And in the wealth management business, the best of breed practice is to use a custodian as a way of protecting the client. So your wealth advisor says, okay, we're going to put you in a diversified portfolio, and we're going to use, the money is going to be held in a custodian, say Schwab. You, the client, always have power and control with the custodian, regardless of who's managing your money. And so you can go into that account and see what's in it. And if your advisor says you're in a diversified portfolio, and you go into your portfolio through your custodian and you see that you're all in biotech stocks, like, whoa, there's a problem, right? That's what happened with Madoff. Madoff, their clients' money was not held by a custodian. He was the guy holding the money, he was the guy doing the accounting, and he was the guy who was so-called investing it. And so that separation of church and state, the separation of powers, having a custodian be separated from the firm that is your wealth management firm, is one of the ways that people protect their assets in professional wealth management. But even more than that, it protects them because the money, the securities that are held on their behalf are kept in segregated accounts. Whereas in banks, that's not true. And so the good news is, short term, your money is guaranteed up to $250,000 per account. And some of the more innovative banks have created programs that can allow that number to be higher, but it's still something you've got to monitor. And there are a lot of people that, when those banks that you mentioned, Clinton, went bankrupt and were taken over by the government over the last 2 months, there are a lot of people there that even if they know in their head, oh, okay, I'm guaranteed up to 250, it's a pretty frightening thing when your life's retirement or savings are suddenly up in the air and you're reading about your bank being taken over and aren't sure about what's going to happen next. That's a lot of stress. And so I think there's more and more people that are waking up and going, I don't want to be paid 0.4%. I want to be making what I deserve. And B, I just don't want to have to worry about that when I'm playing golf or I'm traveling. I don't want to have to worry about reading a headline saying that my bank's been taken over and just praying that everything goes perfectly. What can I do to better protect my assets? And so for traditional assets that require a brokerage firm, I think using a custodian and certainly cash as well. There's probably a handful of large respected ones, Schwab, Fidelity, State Street, just to mention a few. And I think big is important. This is really, if you think about this, and I made a reference to it earlier, big when it comes to custodian is important. Why? Because you want that custodian to be profitable. For example, Schwab made, I think, $6 billion in income last year. And so they're big enough that they can afford to hire a top-rate cybersecurity division to protect your assets. And if you think about what money is today, what security is today, it's a digit on a computer screen or on your phone, right? I mean, it's really what it is. So the risk is no longer the bandits come and hold up the bank and take your money. The risk is cybersecurity. And so a larger custodian that has the resources to protect your assets, I think is going to be better off than a smaller custodian. And in the alternative world, it's a little bit different because the investments themselves are often very illiquid. So if you're investing in a venture capital fund or a lending fund or private equity fund or a niche distressed investment fund, you're signing those documents, or your self-directed IRA is signing those documents, and there's that legally notarized proof, written proof that you own that asset. So it can't be stolen in the way that we've seen cybersecurity type scams. But certainly in crypto, I think everybody on here on the show today who owns crypto would agree that cybersecurity is important, which is why we've constantly seeing new evolutions of how do you protect. Is it cold storage? Is it multi-sig? What are the different technologies today that keep your assets, your crypto assets, secure? And we're seeing a lot of innovation in that space. So long story short, I think it's really, if you have a lot of cash sitting in a bank, it's important that you just understand the difference between a bank model versus a custodian and evaluate, which of those is appropriate for you.
If I can rephrase kind of what you're saying in, let's say, crypto investor terms, not your keys, not your coins. When it's your keys, you're the custodian. When it's somebody else's keys, they have it. They have custody over it. And therefore, what you're saying is you have to trust that they actually have good processes in place. They have financial stability, a whole slew of things. I mean, the individual investor shares the exact same challenges that you just articulated these big companies have. Like, do I have a good VPN? Do I have antivirus? How do I know somebody's not going to come in and steal off my ledger, my coins? How do I keep those passwords safe? All these little dramas that we experience as a small time investor, just times 100 is what these large companies are doing, but they have the money and the financial stability to put the best practices in place.
You had shared that, hey, within your realm, you're the expert, but that sometimes when you're part of conversations in, certain type of trust structures or certain investment areas, that while you kind of understand at a high level, sometimes, the jargon that people use can just kind of be very overwhelming at times. And I feel the same. And I wanted to acknowledge that because I think a lot of people experience the same thing. And I wish I could say otherwise, but I'll confess I was that guy after graduating Wharton and getting my CFA that was speaking in this kind of foreign language, this, finance speak, lingo, blah, blah, blah. And I probably put hundreds of people to sleep. And I've had to work really hard today to where we now consider it a principle, an important principle in our business, that we be able to explain to clients the absolute essence of what we're talking about without compromise. no dumbing down, but be able to explain it in clear terms. And the reason I'm sharing that is that it is important if you're working with somebody, whether they're an attorney, whether they're a wealth management firm, whether you're doing tax planning, estate planning, you're putting trusts in place, please, please be strong and don't be afraid to ask questions until you understand what they're talking about. Because I promise you that in all even the most advanced estate planning stuff we do, when you really break it down and you look at what's happening inside the plan, anybody can understand it. It's just when you introduce all those weird words that mean to most of us in our day-to-day life that you can be like, oh, what did that guy just say? And even me, even though I'm in the industry, I'm doing that stuff every day. When I get trust documents and I'm reading them, I will often read a paragraph and go to myself, I have no idea what that said. I'll have to read it again and sometimes read it again because, the lawyers speak and all the different words, it is like a different language. And I'll share with you one. I was in a meeting once where an estate planning attorney was essentially trying to sell me and the client on a particular type of trust. And they gave it a name. And I think that the reason they gave it a name is to market it. Oh, we have this kind of a trust. Okay. And I didn't know that name. Why? Because it was a new name they invented to sell it, to make it marketable. So I was asking this guy questions about this trust to understand. See, trusts are a super powerful vehicle, but not one is the same as another. There's kind of like 5 or 6 different key things that you can change. And there's just like an infinite number of variations in terms of the trust that you end up with. Think like Rubik's Cube, right? It's got 6 sides, 6 colors, but there's an infinite number of combinations, same kind of thing. And so they're very powerful, but they can be very overwhelming because, you have people talking about them as if they're a thing, when in fact, they're each very, very highly customized. So I'm talking to this guy, I'm asking him questions. Oh, it drove me crazy, Clinton. I kid you not. It took me 45 minutes of asking questions to finally I realized, oh, he's just talking about this kind of trust and just gave it a fancy name. And it pissed me off. I was just so worked up. I was like, really? We need to spend 45 minutes? You could have just told me, you just gave it a cute name. But it was like that military intelligence game, right? Where I'm trying to ask a question, what is special, and finally figure out it's just a plain old vanilla trust, XYZ kind of trust. And I'm like, oh, why did we have to spend 45 minutes of our life to do that? And that's me, right? So you can imagine how, somebody that's not even in the industry, how easy it is to get overwhelmed. So whoever your advisor is, don't ever compromise. Like if you're in a meeting and you don't understand what's being said, it's your obligation. It's your job. Say, hey, please explain that again. And if you don't understand the explanation, say, hey, I still don't understand it. Is there a different way you can explain it? And insist on it because it's important that you understand your plan.
That's really good. Warren Buffett says that he doesn't invest in any company he doesn't understand. And what you highlighted in that illustration was that the marketing side of these investments motivates those who are presenting it to not only to tell you about their product, but also to confuse it in comparison to others. They create confusion, and that confusion is to make you feel stupid and that they're smart. So you're exactly right. I completely agree with you.
Yeah, hey, funny, Clint. I literally 2 days ago I was on the phone with a new client of ours, and I forget the name of the acronym. It's some new name that another advisor that he had been speaking with gave him about. It was like a permanent life insurance strategy to grow your money tax-free, right? It's a really common, basic use case, one of kind of a handful of use cases in permanent life insurance. But he had a cute name. He's like, are you familiar with this particular strategy? Like, I'd never heard that name before. I'm like, nope, but I guarantee you I know the underlying strategy. So I said, describe it to me. And he describes it. I'm like, oh, that's just a plain vanilla use of permanent life insurance. But sure enough, that the advisor who had been pitching him on that gave it this really cute name and an acronym, and he thought it was like a unique thing. I'm like, no, that's just plain permanent life insurance structured a certain way. And it drives me crazy when it's like word games, right? Just shoot straight with me, please. Just tell me what it is. You know, drives me nuts.
I agree. Hey, I had just today, I had a guy was wanting me to sign a real estate agreement to list a property I'm trying to sell. And the penalty clause in this, it's a 3-page listing agreement. And the penalty clause, there were sentences that were over 100 words long. And by the time you found the period, you had no idea what the sentence said. And I sent it back to him. I said, this is torturous to read. You're demanding, it's a totally lopsided agreement. You're very vague about what you're going to do, but whatever your penalty is, I don't understand it. It's very overly described. So I'm not signing it. And I'm sure I'm not the first person to tell you this was confusing. So I just push it right back at them. I mean, it's no excuse for when lawyers do it. They do it to confuse, hide, and obfuscate. I mean, it's just terrible. Hey, we got a little time left. One of the things that I find a lot of my clients experiencing, big wealth growth, they really expecting big payoffs. And I think it will. I mean, they have coins that are at 40 cents and they're expecting to hit $40. So when somebody has that windfall, or let's say their asset value has got to that point where they're thinking about selling, but then they have a tax event, of course, if they sell. What am I going to do with this cash? Where am I going to put it? Nobody goes broke paying taxes. But if you forget to pay taxes, it may make you broke. So what would you do if somebody came to you and say, hey, look, I've been investing in a couple coins and I now have $10 million of net worth in these coins. How do I get out of this? How do I diversify? How do I keep as much as I can?
2 key words that need to be on everybody's mind are plan and number 2, trade-offs. So, if you don't have a plan, the emotions are too hard to overcome in most cases when things are flying. And it's too easy to just go, no, I'm going to keep holding, I'm going to keep holding, I'm going to keep holding. And if you decide to just sell on a whim, likewise, you can have, the regret of selling if it keeps going up and up and up. By contrast, if you have a written plan and say, look, here's the deal, kind of like what you said earlier, when it hits this milestone, we're going to sell a third. And we then know how much we need to put aside for taxes. We then have a plan on where that money's going to go and how that will serve you, the client. So it's not just, hey, sell because due to some vague concept of whatever you should sell. A plan makes it personal to you. So you're going to sell a third and you're going to put, we need to put some of it away for taxes. And then here's how the remaining money is going to benefit you. And when people can see a direct connection to how taking that action and how they benefit, then 9 out of 10 people are fine. They're like, okay, great, that makes sense. And I still have this exposure here. And then when it hits this point, then I'm going to sell another third, or whatever the case may be. Having that in advance and knowing how you benefit from it gives people the confidence to make that tough decision to sell. The other thing that gives them relieves the stress is having a plan for the taxes, knowing how much you need to set aside so that you don't get in trouble. The other part of that is just trade-offs. So for a lot of clients, often you can think of people as often having 3 different buckets. They might have a kind of a stay rich lifestyle bucket that we want to fund. And the goal there is to protect your livelihood. So this is the bucket that we want to lock down, protect, asset protect, and we want it to grow and stay ahead of inflation. But this is the bucket that you don't want to bet the farm on, right? You might have a second bucket that's your entrepreneurial bucket. Maybe you're building a business. Maybe that's some highly speculative coins that you're really excited to participate in, that you have some insight into. Could be a number of things. For that bucket, what you want is a team that's watching your back and helping you manage risk. If it's starting a new business, making sure you're using the right kind of entity, the right kind of insurance, If it's, coins, it's just making sure, hey, how are you protected in terms of how you're holding them, making sure that you're giving thought to that. Some clients are thought leaders on that. Other clients, maybe haven't thought about that as much as they should. And then the third bucket is the giving bucket, right? So maybe that's kids, maybe that's a charitable cause that you're really passionate about. And each of those different buckets, and people might have more than that, right? They might have their own buckets. But the point is that you're a human being and there's not just one formula for you. You might have 2 or 3 or 4 different buckets, and each of those buckets have a very different objective. They might have a different risk tolerance. They might have a different liquidity need. And so you really need to treat them differently. And so that's the other thing that I think is important in terms of thinking about trade-offs is, okay, how do I fund my lifestyle bucket? How do I still keep some skin in the game, right? And if you're a parent or you have kids or a cause that you're passionate about, giving thought to what amount of resources you want to invest in your giving bucket. I had a conversation with a client earlier in the week where he said, Stefan, when I hit 10 million, if I can make 10 million after tax, I'm good. I don't need to be the guy that needs $1 billion. At 10 million, my wife and I can live on a beach, have a fabulous life, can kick back, take fun trips, don't have to work too hard. I'm good with that, right? There are other clients that one guy in particular, he is going to keep building a business until he's hit that $1 billion mark. And so for different people, they're going to have different trade-offs. And it's important that you just get help from an advisor quantifying the trade-offs to that, should I sell or should I not? And once you understand the trade-offs, then it makes it much easier to make a choice. It's like, the analogy I'd make is when I first moved to New York City and I was trying to find a place to rent, and I met with a leasing agent, and the first question they asked me just really bothered me. They're like, how much do you want to spend on an apartment? Like, I don't know. I just graduated. I don't have any money. I don't know, like $10, like I don't even want to answer that. Right. But it's when that leasing agent, I said to her, give me an understanding. What are the trade-offs? If I spend $1,000 a month, what do I get? If I spend $5,000 a month, what do I get? And once I understand the choice set and kind of real practical trade-offs, it's much easier at that point, pick which one's best for you. Right. And so I think that more than somebody telling you, do this, a conversation where you can explore those trade-offs and find out what's right for you is going to give you that confidence to ultimately make smart decisions that you need to protect your wealth, to be a little more diversified, but know that you're doing it in a way that is consistent with your values and what you want your life to look like.
Well, that is very good advice, Stefan. I wish everybody watching the show had a need to solicit that advice, that they have such a windfall that they can really engage on those issues. Tell everyone how they can contact you in the future.
Good place to start is our website, which is whitwelladvisors.com. And my contact information is on there, as well as everyone on our team.
Well, thank you very much. Thanks, everyone, for taking your time to listen to this very thoughtful conversation about a problem we all like to have. So until next week, remember, taxes are sexy.
Welcome to the Clinton Donnelly Show, where we explore how taxation and regulations of cryptocurrencies affect your daily life as an investor. Clinton has a law degree in international financial regulation. He is an enrolled agent and certified as a cryptocurrency anti-financial crime specialist. He has clients in 71 countries. He is one of the top experts in crypto taxation in the US. This show is sponsored by CryptoTaxAudit.com, the income tax experts for US crypto investors. Are you frustrated with using online crypto tax services to calculate capital gains? Are you a high-frequency trader, DeFi, NFT, play-to-earn, or whale investor? Nothing is too complicated for the experts at CryptoTaxAudit.com. Are you frustrated that your accountant doesn't understand crypto taxes? Crypto Tax Audit uses a proven, bulletproof crypto tax return methodology to prepare a tax return that doesn't attract the attention of the IRS. Crypto Tax Audit also offers an exclusive audit defense membership service. It's like car insurance for your tax return. If your return gets selected for an audit of crypto reporting, they will defend you at no additional charge for the entire life of the audit. No one offers anything like audit defense membership. Go to cryptotaxaudit.com to learn more and schedule a private tax consultation now. The opinions expressed in this show are not legal advice. Tax and regulations are complicated. Your situation is unique, so you should always consult a tax professional.